Welcome to our deep dive, into the world of derivatives.
Okay,
We're using John Hull's book, Options, Futures, and Other Derivatives.
that's good.
So consider this like a shortcut to understand these complex financial instruments,
Right,
without needing a doctorate in finance.
for sure.
So let's just jump right in.
Okay.
Imagine you're a farmer and you are facing like uncertainty about corn prices before harvest.
hmm
Like, what could you do to protect yourself?
Well, that's a great starting point
Yeah.
because at their core, derivatives are financial contracts
Okay.
whose value is derived from an underlying asset.
Okay.
That asset could be anything from stocks, bonds, to commodities like gold, oil, or even things like weather patterns.
So it's like a safety net,
Exactly.
ensuring a certain level of like profit,
Yeah,
regardless of how the market fluctuates.
exactly.
But beyond that, like, why would anyone use these
Well,
instruments?
Hull's book actually outlines three primary motivations:
Okay.
hedging,
Okay.
speculation,
Right,
and
right.
arbitrage.
Those seem like very different things.
They are different approaches to using these derivatives.
Okay.
So, for example, hedging that focuses on mitigating risk.
Okay.
So let's say we have a company that's heavily reliant on wheat, maybe a food manufacturer.
Right.
They could use derivatives to secure a predetermined wheat price for the future,
Okay.
protecting themselves against potential price increases.
That's a pretty smart strategy.
It is.
It's like taking out an insurance policy
Yeah,
against market volatility.
exactly.
But speculation seems riskier.
Absolutely.
What's that about?
Speculators use derivatives to profit from price movements,
Okay.
basically betting on whether an asset's value will go up or down.
Oh,
So naturally, this can lead to big gains or big losses.
right. High risk, high reward.
Exactly.
And then arbitrage.
Arbitrage, that's the art of exploiting price differences between markets.
Oh.
So arbitrageurs try to make risk-free profits
Oh.
by simultaneously buying and selling linked assets. It's like finding a product priced differently in two stores.
Oh.
You buy it at the lower price and immediately sell it at the higher one.
Gotcha. So arbitrageurs act as a balancing force,
Right.
taking advantage of inefficiencies.
Exactly.
But speaking of the market,
Yeah,
the derivatives market is huge.
it's massive.
What kind of numbers are we talking?
Well, Hull's book highlights this phenomenal growth, particularly in the over-the-counter segment.
What's that?
OTC. That's where transactions occur directly between parties,
Okay.
often involving huge sums of money without the oversight of an exchange.
So it's less regulated.
That's a great point. And
It sounds kind of risky.
it can be, and that's why the derivatives market has seen major regulatory changes in recent years,
Oh.
especially after the 2008 financial crisis.
Right.
These reforms aim to bring more transparency and stability to the system.
Like how?
Well, Hull points to some key changes, such as increased capital requirements for institutions trading derivatives, mandatory clearing of standardized derivatives through central counterparties, and enhanced reporting and disclosure obligations.
That's good.
Yeah, it's all about reducing the risk
Right.
and ensuring market integrity.
Okay, well, let's dive into specific derivative types.
Okay.
Hull talks about forward contracts, futures, contracts, options, swaps. It's a lot.
It is.
But let's start with forward contracts. How do they work?
So picture this. A farmer anticipates a specific corn yield,
Go.
ready for sale in 6 months. They could enter into a forward contract with a buyer today, locking in a price for that future corn delivery.
Oh, so it protects the farmer
Right.
from the uncertainty of future market prices.
Exactly.
And it gives the buyer a guaranteed supply at a price they agree on.
Right. It benefits both sides.
Okay, but how are futures contracts different?
Futures contracts are basically standardized forward contracts.
Okay.
They are traded on exchanges
Okay.
with predefined terms like quality of the asset,
Gotcha.
and they're subject to something called daily settlement.
Daily settlement. What's that?
So it means that gains and losses are calculated and settled every day.
Wow, every day.
Yeah, if the asset's price moves in your favor, your account is credited with the profit.
Okay.
And if it moves against you, you have to cover the loss.
So it's riskier than a forward contract.
It can be because of this constant adjustment.
Right. Okay, what about options?
Options give the holder the right, but not the obligation,
Oh, I am.
to buy or sell an asset at a specific price within a specific time frame.
So I could have the option to buy a concert ticket at a fixed price.
Exactly.
And then I could decide later if I want to go.
Precisely, you have the choice.
So that's a call option.
Right, call option gives you the right to buy.
Okay, and a put option gives you the right to sell.
Exactly.
Got it. What about swaps?
Swaps are agreements to exchange a series of cash flows over a period of time.
Okay.
A common example is an interest rate swap,
Hmm.
where one party agrees to pay a fixed interest rate and receive a floating rate,
Okay.
and the other party does the opposite.
So they're swapping interest rates.
Exactly. It's a way to manage interest rate risk and make things more predictable.
That makes sense.
Yeah, it's about managing uncertainty in the financial world.
Right. Okay,
You
so
know,
we've covered a lot of ground here,
we have.
and I'm starting to get a better grasp
Good.
on how these derivatives work.
That's great to hear.
But Hull's book goes into more detail about key concepts.
Right, like margin,
Okay.
daily settlement, which we touched on,
Yeah.
and central counterparties.
What are those?
We'll dive into those next.
Okay. Sounds good.
We'll unravel these concepts and see how they play out in real-world scenarios.
Okay. I'm ready for more.
Let's do it.
All right, let's continue our deep dive.
Okay.
It sounds like companies could use these swaps to lock in predictable interest payments on their loans, right?
Exactly.
Kind of shield themselves from those fluctuations.
It's all about managing that uncertainty.
But this whole world of derivatives,
Mm.
I mean, it's starting to make more sense. But Hull's book, it stresses these key concepts,
Absolutely.
like margin,
Right.
the daily settlement,
Yep.
and then these central counterparties.
Exactly. Those are crucial to understanding how it all works.
Okay, can you break this down for me?
Sure. So let's start with margin.
Okay.
Think of it like a security deposit
Oh.
that traders have to put up to cover potential losses on their derivative positions.
So it's a way to ensure they can meet their obligations.
Precisely. It's about financial responsibility.
And we talk about daily settlement with futures contracts.
Right. That's where gains and losses are calculated every day
Yep.
to manage risk.
But what about these central counterparties?
CCPs,
What do they do?
they act as intermediaries in derivative transactions.
Okay.
So instead of two parties dealing directly with each other,
Right.
the CCP steps in as a counterparty to both sides.
Doesn't that make things more complicated?
It might seem that way, but actually CCPs help reduce risk.
Wow.
They act as a safeguard against counterparty defaults.
Oh, so if one party can't meet their obligations,
Exactly. The CCP steps in to ensure financial stability.
that makes sense.
And they also streamline the clearing and settlement process, making the market more efficient and transparent.
Because they play a pretty important role.
They are vital for the stability and smooth functioning of the derivatives market.
Okay, so we've got these concepts,
Right.
but how do they actually play out in the real world?
Well, Hull gives some great examples of companies using derivatives for hedging.
Okay, like what?
For example, a U.S. company expecting a payment in euros in 6 months.
Okay.
They could use a forward contract to protect themselves against the euro depreciating against the dollar.
So they lock in an exchange rate.
Exactly. They eliminate the uncertainty.
That's pretty smart.
It's a common way to manage foreign exchange risk.
What about hedging against interest rate risk?
Companies can use interest rate swaps for that.
Oh, okay.
Imagine a company has a loan with a variable interest rate.
Like LIBOR.
Exactly.
Yeah.
If they're worried about rates going up, they could enter into an interest rate swap,
Mm-hmm.
agreeing to pay a fixed rate and receive the floating LIBOR rate.
So they basically convert their variable rate loan into a fixed rate loan.
Precisely. It provides stability and predictability.
Makes budgeting easier.
Absolutely.
Okay, so we talked about hedging,
Yes.
but what about speculation?
Well, speculators use derivatives to try and profit from price movements.
Right.
They might buy call options on a stock if they think the price will go up,
Okay.
or sell put options if they think the price will go down.
So they're betting on the direction of the market.
Exactly, and hoping to make a profit.
But that sounds pretty risky.
It is. Speculation involves a higher level of risk.
And what about arbitrage? Is that something anyone can do?
Arbitrage opportunities are usually very short-lived,
Okay.
and they require sophisticated strategies and tools to identify and exploit.
So it's not really for the average investor.
It's mostly done by institutional investors and hedge funds.
Okay, so arbitrage is out.
For most individual investors, yes.
All right, well, Hull's book also talks about derivative pricing.
Right. How these instruments are valued.
How do they do that?
It's a complex process involving mathematical models,
Mm-hmm.
statistical analysis,
Okay.
and a good dose of market intuition.
Sounds complicated.
It can be, but one of the key principles is the concept of no arbitrage.
No arbitrage. What's that?
It means there should be no opportunities to make risk-free profits by buying and selling related assets.
Okay.
If those opportunities existed, arbitrageurs would quickly take advantage of them.
Right, they would eliminate the price difference.
Exactly, and that principle underpins a lot of the derivative pricing models.
So the price of a derivative should reflect its true market value.
Right, taking into account things like the price of the underlying asset,
Okay.
its volatility,
Right.
time to maturity, interest rates, dividends.
It's a lot to consider.
It is, and it's important to remember that derivative markets are constantly evolving, influenced by regulation technology and global economic conditions.
So it's a constantly changing landscape.
It is, and that's what makes it so fascinating.
Okay, so Hull's book gives us a good foundation,
Yes.
but there's always more to learn.
Absolutely.
Before we get into some of the stories and case studies from the book,
Okay.
let's take a step back and reflect on what we've learned so far.
That's a good idea.
Let's solidify our understanding.
All right, so one of the most captivating stories in Hull's book is about long-term capital management.
LTCM.
Yes, a hedge fund filled with brilliant minds,
Like,
including Nobel laureates.
wow.
They were known for their sophisticated derivative-driven investment strategies.
Sounds impressive.
It was, but it all came crashing down in 1998.
What happened?
Well, their strategy relied on exploiting tiny price differences in bonds,
Okay.
and they used a lot of leverage through derivatives to amplify their bets.
Leverage meaning they were borrowing money.
Exactly. They were betting that these price differences would eventually converge.
And did it work?
For a while, yes.
Oh.
LTCM made huge profits in its early years.
Like how much?
They were achieving returns of over 40%.
Wow. They must have thought they had it all figured out.
They did. They seemed to be defying conventional wisdom.
They were like financial rock stars.
Yeah, for a time.
Then what happened?
Well, then the Russian financial crisis hit.
Oh.
And that sent shockwaves through global markets.
Right.
Investors panicked and started selling risky assets.
Like a flight to quality.
Exactly. Everyone wanted safe and liquid investments.
And that messed up LTCM strategy.
It did. Those price discrepancies they were betting on,
Yeah.
they widened dramatically.
No.
And all that leverage they were using,
To amplify their gain.
it backfired. It amplified their losses instead.
So it was like a perfect storm.
It was a combination of unforeseen events and an over-reliance on complex strategies,
A reminder that even the best can get it wrong.
especially in the world of finance.
So what happened to LTCM? Did they just disappear?
They faced a severe liquidity crisis.
Meaning they didn't have enough cash.
Exactly. They couldn't meet their margin calls.
Those security deposits we talked about.
Right. If they hadn't been so leveraged,
Yeah.
they might have survived,
Oh.
but they had to sell assets to raise cash.
And that probably made things worse.
It further depressed market values.
A downward spiral.
Exactly.
So it's a cautionary tale.
It shows the dangers of too much leverage.
And the unpredictable nature of markets.
Absolutely.
Did LTCM's collapse have any broader impact?
It raised concerns about systemic risk.
The risk that one company's failure could bring down the whole system?
Right, regulators started worrying about other highly leveraged institutions.
And did it lead to any changes?
It prompted reforms to increase oversight and reduce the risk of a similar event happening again.
So LTCM's failure was a wake-up call
It was a lesson learned the hard way.
about the importance of prudent risk management.
In any financial market, but especially with derivatives.
Okay, so let's shift gears a bit. Let's talk about delivery procedures for futures contracts.
Okay.
What actually happens when a futures contract expires?
Most futures contracts are actually closed out before they reach maturity.
Okay.
But understanding the delivery process is important
Why?
because it influences the futures price.
How so?
Well, the possibility of physical delivery keeps the futures price grounded in the reality of the underlying asset.
So the futures price can't stray too far from the actual price of the asset.
Exactly.
But wouldn't actual delivery be difficult for some assets?
It can be, especially for commodities like oil or livestock.
Right, it would be a logistical nightmare.
That's why many futures contracts allow for cash settlement.
What's that?
Instead of delivering the actual asset,
Yeah.
the parties just settle the difference between the futures price and the spot price in cash.
So it's like a shortcut.
It makes the settlement process much simpler.
Okay, so we've talked about futures.
Right.
Now let's compare them to forward contracts.
Sure.
Hull's book points out some key differences.
The main difference is standardization and trading environment.
Okay.
Forward contracts are customized agreements between two parties,
Right.
traded over the counter.
So they're more flexible,
Exactly.
but futures contracts,
They are standardized and traded on exchanges.
with clearinghouses acting as intermediaries.
Right, which adds transparency and structure.
So futures are more transparent and liquid,
Yes,
and forwards are more customizable.
precisely.
But what about pricing? Are there big differences?
In theory, forward and futures prices should be the same
Okay.
if interest rates are predictable.
Hmm.
But in practice, there can be small variations.
Because of things like daily settlement.
Exactly. Those nuances can create slight price discrepancies.
Hull talks about something called tailing the hedge
Right.
to address these discrepancies.
It's a technique to fine-tune a futures hedge
Okay.
so that it accurately reflects the value of the corresponding forward contract.
It's like making adjustments to ensure the hedge is precise.
Exactly. It minimizes basis risk.
The risk that the futures price might not move in sync with the asset being hedged.
Right. It's all about aligning the derivative with the underlying asset.
Okay, so we've talked about hedging with futures.
Yes.
What about hedging with options?
Options offer more flexibility than futures.
How so?
Remember, the holder has the right, but not the obligation.
To buy or sell the asset.
Exactly. So options are great for situations where you want protection against adverse price movements,
Okay.
but you also want to participate in potential gains.
So it's like having your cake and eating it too.
In a way, yes.
Can you give me an example?
Sure.
All right.
Let's say a company owns a lot of stock,
Yeah.
and they want to protect themselves against a price drop.
Right.
They could buy put options.
Which give them the right to sell the stock at a certain price.
Exactly. So if the price falls, they can exercise their option and limit their losses.
But if the price goes up,
They don't have to exercise the option.
they can still profit from the increase.
Right. It's a way to have downside protection while still maintaining upside potential.
But options aren't free, are they?
No, they have a premium.
Which is the price you pay for the right to buy or sell.
Exactly. It's the cost of flexibility.
Okay, so options give you choices.
And choices have a price.
Makes sense. What about speculation with derivatives?
Well, speculators use derivatives to try and profit from price movements.
Right.
They might buy call options on a stock if they think the price will go up,
Okay.
or sell put options if they think the price will go down.
So they're essentially making bets on the market.
Exactly, and hoping to make a big profit.
But speculation is risky
It is. It requires a good understanding of the market.
and a high tolerance for risk.
Absolutely.
Are there other speculative strategies?
Sure. Speculators also use futures contracts
Okay.
to speculate on commodity prices.
Like oil.
Exactly. They might buy oil futures if they think the price will rise.
Or sell them if they think it will fall.
Right. It's all about trying to anticipate market movements.
But again, it's risky.
Speculation always carries more risk than hedging.
Okay, so we've covered a lot of ground in our deep dive into Hull's book.
We have. It's been a fascinating journey.
It really has. We've explored the basics of derivatives,
And there are many uses.
from hedging to speculation.
And everything in between.
So let's wrap up with some key takeaways.
Okay, good idea. Let's distill the most important points.
Let's give our listeners 10 key things to remember about derivatives.
10 nuggets of wisdom.
Exactly.
Okay, number one, derivatives are powerful financial instruments.
With a wide range of applications.
Right. Number two, understand the underlying asset before using derivatives.
Don't jump in without knowing what you're dealing with.
Exactly. Number three, derivatives can be used for both hedging and speculation.
But each approach has different risks and rewards.
Right. Number four, options offer flexibility but come at a price while futures offer standardization and liquidity.
Choose the right tool for the job.
Number five, margin and daily settlement are key risk management mechanisms.
They help keep the market stable.
Number six, central counterparties reduce counterparty risk.
Adding another layer of protection.
Number seven, the principle of no arbitrage underpins derivative pricing.
Ensuring rational prices.
Number eight, remember the lessons of long-term capital management.
Leverage can be dangerous.
Number nine, understand delivery procedures and the relationship between forward and futures prices.
They influence market dynamics.
And finally, number 10, never stop learning.
The world of derivatives is constantly evolving.
Stay curious and adapt to change.
Those are 10 great takeaways.
I'll give our listeners a solid foundation.
As we conclude our deep dive, let's leave our audience with a question to ponder.
Okay, what is it?
Given the rapid advancements in technology,
Like AI and machine learning.
how do you see the derivatives market changing in the future?
That's a tough one.
Will these innovations make sophisticated trading strategies more accessible?
Or will they concentrate power in the hands of algorithms?
It's a fascinating question.
It is the future of finance is uncertain.
But one thing's for sure, it's going to be interesting. Well, that wraps up our deep dive into the world of derivatives.
It's been a pleasure.
Thanks for joining us, and until next time, happy investing.